Ladies and gentlemen, good day and welcome to conference call to discuss CreditAccess Grameen Q2 FY24 earnings. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Shweta Daptardar from Elara Securities Private Limited. Thank you, and over to you, ma'am.
Thank you, Sagar. Good evening, everyone. On behalf of Elara Capital, we welcome you all to the earnings conference call of CreditAccess Grameen to discuss the Q2 FY24 earnings performance. From the esteemed management today, we have with us Mr. Udaya Kumar Hebbar, Managing Director, Mr. Ganesh Narayanan, Chief Executive Officer, Mr. Balakrishna Kamath, Chief Financial Officer, Mr. Nilesh Dalvi, SVP and Head Investor Relations. Without much further ado, I now hand over the call to Mr. Hebbar for his opening comments, post which we can open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Shweta. Dear all, warm welcome to everyone, and very happy Navratri to you and your family. We thank you all for joining the conference call to discuss our second quarter and first half FY24 financial performance. We have witnessed another healthy quarter reflecting strong growth momentum. We are confident of maintaining a business traction in FY24 with all key foundation blocks in place. The rural demand continues to remain strong, supported by high entrepreneurship spirit. Despite Q2 being historically weaker quarter due to seasonality, we continue to witness robust growth in our borrower base in Q2 FY24. We added 3.36 lakh new customers, of which 40% came from outside the top three states. Overall, in H1 FY24, we added a healthy 6.64 lakh new customers with an average monthly addition of over 1.1 lakh, demonstrating customer-led growth across our operating markets. The customer base grew by 21.2% YOY and 4.1% QOQ to 46 lakh, while the AUM grew by 36% YOY and 3.1% QOQ to rupees 22,488 crores. Disbursements grew by 13.5% YOY in Q2 FY24 to rupees 4,966 crores. We forayed into Andhra Pradesh and Telangana in line with our contiguous district-based approach. With this expansion, our presence is across 16 states and 1 union territory. Our branch infrastructure stood at 13,877 spread across 364 districts, with 51 new branches opened in this quarter. Our interest income grew by 53.9% YOY and 7.4% QOQ to rupees 1,187 crores. Our average and marginal cost of borrowing for Q2 FY24 stood at 9.8% and 9.6% respectively. The increase in average cost of borrowing was primarily on account of $100 billion drawdown of special loan in June 23, followed by INR 990 crore public NCD in September 23. We believe that our cost of borrowing would largely peak out at 9.8 to 9.9%, but the incremental drawdown planned for the next 2 quarters are predominantly from domestic sources, as we have by and large achieved our foreign borrowing requirements. Our NIM stood at 13.1% for the second quarter, as the increase in borrowing cost was offset by the increase in our portfolio yield. Further, NIM primarily benefited due to 3 factors. One, superior asset quality leading to minimal interest reversal, strong control on cost of borrowing, higher share of portfolio growth funded through internal accruals. It is important to note that we have delivered healthy NIMs while still remaining one of the low-cost lenders for our customers. We successfully raised INR 990 crore in September 23 through the second tranche of our public NCD. These funds came at an average coupon rate of 9.3%, which is 3% lower compared to our first tranche last year, with an average tenure of 3 years. The share of public NCD now stands at 7.9%. The share of foreign borrowing stands at 18.4%, and share of long-term borrowing is around 17%. Around 70%. This has further strengthened our ALM position with an average maturity of assets at 19 months and average maturity of liabilities at 25.2 months, resulting in a positive mismatch of over 6 months. The robust liability strategy embarked by us has helped us to address liquidity, positive ALM, long-term funding, and adequate diversification, along with lower price to our customers. While our pricing is one of the lowest in the market, we have been further able to retain our pricing, which was last changed in February, and we shall be maintaining our pricing even during Q2. Our operating profitability continued to follow an upward trajectory, with the net interest income growing by 49.6% YOY to rupees 772 crore. Cost to income ratio was 31.7% on the back of improved income profile. PPOP grew at a healthy pace of 68.3% YOY to INR 560 crore. The credit cost stood INR 96 crore, which was partially offset by INR 11.7 crore of bad debt recovery, resulting in a net credit cost of 0.4% non-annualized in Q2 FY24. The H1 FY24 net credit cost stood at 0.1% non-annualized, and our collection efficiency, excluding arrears, was steady at 98.1%. GNPA measured at 60+ DPD further reduced to 0.79% compared to 0.89% in the last quarter, whereas net NPA stood at only 0.24%. Our PAR 90 is at 0.6%. We continue our effort to maintain the best-in-class asset quality underpinned by various quality controls in place. PAT grew 98.1% YOY to rupees 347 crore, resulting in ROA of 5.6% and ROE of 24.7%. Our H1 FY24 ROA stood at 5.7% and ROE at 25.5%. Capital adequacy remained comfortable at 25% at the end of Q2 FY24. On the back of our operating performance during H1 FY24, we are happy to provide you with revised guidance for FY24. The key factors which have resulted in the upward revision are more balanced growth across all parameters, 2, improved total income profile and profitability, 3, robust capital adequacy leading to a higher share of growth getting funded through internal accrual, and 4, strong control on cost of operations. We maintain our portfolio growth at 24.25%. We expect the improvement of NIM in the range of 12.7 to 12.8%. Cost to income ratio, which will be in the range of 31.33%, while we maintain credit cost at 1.6 to 1.8%. We expect improved ROA and ROE in the range of 5.4 to 5.6% and 24 to 25% respectively. Thank you for your patient hearing. We look forward to answering your all queries during this question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Renish from ICICI. Please go ahead.
Yeah, hi sir. Congrats on a good set of numbers. So just 2 questions from my side. First is on the liability side. now, given our balance sheet size, which is now almost touching 25,000 crore, and we being in a complete unsecured product business. So how we are going to manage our liability side, especially considering the size and a product nature?
Yeah, I think you said two questions.
Yeah, yes. So secondly, on the borrower attrition side, so just wanted to understand that in last 1 year, we have lost almost 0.5 million customer base. Despite we being the leader in the sector, our lending rate is still, far lower than the competition. So to whom we are losing this customer, and if you can also share what are the primary reasons for this attrition?
Okay, thank you. So thank you, Ramesh. The liability side is one of the things we kept on now working to strengthen that strategy since last many years. So we have been witnessing this is going to be one of the primary requirement to expand our liabilities beyond domestic, beyond banks, because the requirement keep increasing at least 25% every year, and then many banks will not be able to give that much of money every year increase funding. Therefore, and also we wanted to build up a very, very positive ALM so that we should not be vulnerable for any liquidity, tight kind of situation. So therefore, we have been planning to expand our liability beyond banks, then beyond to domestic territory, to go to international also. So in this process, we did a couple of things. One is going to non-bank side, which are DFI, and then the international borrowing, and the conventional public entity route. So as a process, as of now, our view was over a period of time, our dependency on the bank should be within 50%, and the 50% of the funding should be outside the bank and as much as possible outside the geography, so that we have a continuous supply of funds with a longer maturity and which will result into higher ALM, positive ALM, as well as very strong diversification. So we are in that process. Probably we are largely in that process today. Almost only 53% of our funding is from banks today. Almost close to 20% is from the international side, which is minimum 3 years, all the way up to 7 years. Another 7 to 8% is from public entities, and then the balance about 11% is from a non-bank DFIs, and then about 7% from normal short-term DA, DRP kind of thing. This is very strong, liability side, what we build. It is most important. I think this strategy is important for us to grow in the future. No? That's why we have made our strategy and working on it. I think this should be helping us continuously while we are diversifying our assets also. So which will match, and then we'll have continuous positive liability mismatches. Maybe second part of question, I will request Ganesh to respond in terms of our attrition and how we are managing. Okay. Thank you, Ram. So Ramesh, attrition for us is range down, currently around 13%, so it's been around 13-15%. Attrition happens because of a combination of a few reasons. As we have stated earlier too, there are certain amount of customers who are moving up. There are certain amount of customers whom we don't want to lend, and there are certain amount of customers who don't want any further borrowing. So generally a combination of these three that comprises our attrition. I think it's in the right track.
Got it. So I was just trying to get a sense that given leader like us losing customer, does it signal the let's say aggressive lending in the segment, or is it the normal attrition rate?
So far we have seen is quite normal, and then I think it's in the range of what we have been observing over last 5-6 years. We are not seeing any new difference. But what we started addressing, the product lines which are addressing by following your customer, to compile some of the pilots what we have been doing last year, which we are scaling it now, which are going to address with one set of customers moving up to the next level of institution or requirement of the larger value that we are addressing to our pilots now. And then who don't want to borrow, who we don't want to lend, anyway we don't want to get into, but those who are going into NBFCs kind of thing. So probably we have already started addressing that to our diversified different non-microfinance product range.
Got it. And sir, sorry, just the last question from my side on the revised guidance. Now, I think, we'll be the first MFI company in the industry, to say that we'll be delivering 24-25% ROE. So is it fair to assume that this will be the, let's say, new steady state ROE, or this is, let's say, this ROE is because of we might be getting some margin benefit as of now and which might not be there maybe a year down the line. So how one should look at this revised guidance, sir?
I think it should be, at least in the medium term to long term, it should be the steady state because our capital adequacy also will be within the same range bound between 20 to 25. We should be able to maintain such kind of steady state ROE going forward.
Got it. Okay. That's it from my side, sir. Thank you and best of luck, sir.
Thank you.
Thank you very much. Before we take the next question, we would like to remind participants that you may press star 1 to ask a question. The next question will be from the line of Ajit Kumar from Nomura. Please go ahead.
Am I audible, sir?
Yes.
Okay. So congratulations for great set of numbers. So first question is on disbursement yield, which has increased by another 10 basis points sequentially. So is there any plan or a scope of increasing this further from here on?
Not really. I think we remarked already that our growth pace is quite comfortable and we are maintaining the same pace to customers. We may not be increasing the pace to customers. By and large, over 90% of our lending portfolio has been already repaid, so there is not too much scope for increasing the yield.
Okay. And so, second question is on the number of employees, which has increased substantially in this quarter. The increase is by roughly 1,800, and which is quite higher than the normal run rate. And this is despite the fact that your number of branches has increased by usual, roughly 50 branches every quarter. So what is the reason for that, and in which function this hiring has happened?
No. Actually, last quarter it was low because a lot of transfers and we are not hired too much. We are in the most of the time we are spending on completing the transition from Madura to us and those things. So now that everything settled, we started hiring back, and it's a normal growth. That is why we said last time our result, whether it's cost of operation, all those are not the benchmark. It will increase a bit, increase one of the branch opening, hiring, tax expenditure, all those we actually told last time also. These are normal. We have to be combined first half year, other than one quarter.
Okay. Sure. Thank you, sir. Thank you.
Moderator, there's some echo in our call. Can you look at it?
I'll definitely check that out. Thank you so much. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah. Hi there, sir. Hi, Manish. Good evening. I hope you are doing well. So just 2-3 questions. First, if you could just explain this insurance distribution income which has come in higher in this quarter.
Abhijit, if you are using a cordless, will you speak through the phone or something? To your not clear.
Is it better now? Is it better now?
Yeah. Okay. Carry on. I think you are using speaker. I think looks like.
Sir, I've come to the handset now. I'm not using the speaker anymore. But let me try.
Okay. Carry on. I think we can make it. Please.
Yeah. So first things first. I mean, this insurance distribution income that we've reported and is much higher than the past few quarters. Just wanted to understand, are there any things which have got bumped up, and kind of there in this quarter, some income which were there for all the quarters and has been booked in this quarter? Or is this now going to be a steady state run rate in insurance distribution income? And if that is the case, what has kind of led to this sharp bump up in the insurance distribution income?
Sorry, I think I understand correctly. So our insurance, which we have been the corporate agent since many years, by regulation we used to get only 5% commission till Q1, and now that IRD has revised the pricing, which allowed the insurers to give a higher commission, which actually increased between 12 to 13, 12 to 15% now. So therefore, this will be a steady state revenue going forward. So there is no bumping. I think only about 8 crores in this, which is insignificant, part of the Q1 accrual. Otherwise, this should be the steady state income going forward, at least the medium range unless regulator changes any fee cap or something. As of now, we should be assuming that we should get this kind of income on a very steady state basis. I don't know anything, second part to your question which you could not hear.
Yes, so I mean, this is exactly what I was kind of trying to understand. So out of this 50 crore that we have reported insurance distribution income, you suggested 8 quarters was approval from the first quarter.
No, actually, in that only 30 crore is the insurance. Others are the normal other income like FD interest or mutual fund interest, all those things. So 30 crore is the insurance additional income, which is a going forward steady state income for the quarter.
Got it. So the second question was again around margins. So if I look at the first half performance in margins, we are around 13.1%, while we guide for 12.7 to 12.8% as the revised guidance for the full year. So fair to assume that given that you said to the prior participant that not much scope for any further increase in yields, given that cost of borrowings will increase from here, what we've reported in this quarter that peak margins, and from here we should see some moderation in margins. Is that the right way to look at it?
First quarter income is actually a kind of based on the base effect, and then the growth also growth is lesser than the internal accrual, so we use more capital. So and when you use the entire year, you use the capital. Then when you use more borrowings also, so that average yield will come down. So therefore, average yield will come down. Therefore, we said in the first quarter, our ROE is 25%. Your growth, annual growth is only about 16%, right? So obviously there is a gap. When you complete the whole year, you will use the borrowing than the capital. So automatically NIM will change. So therefore we guided the steady state NIM for the potential.
Got it, sir. So just one last question. Did this quarter have any impact from floods in the last quarter? I mean, some parts of the country had reported floods. Did this quarter have any impact from floods in the last quarter? And the related question, going forward, I mean, given that we are heading into some state elections, are there any noise or impact that you are seeing on collections from the upcoming elections?
Not really. I think we are not seeing any such impacts. And even in the impact, if it is 15 floods, they automatically would have provided more than 50%. Our per state would have increased. So no such impact so far we observed. And we strongly believe that what we guided is sufficient on the credit cost point of view, as we see for the second half, including second half.
Got it, sir. This is very useful. Thank you, and all the very best to you and your team.
Thank you so much.
Thank you very much. Before we take the next question, participants who wish to ask questions may please press star 1 at this time. The next question is from the line of Shripal Doshi from Equirus Securities. Please go ahead.
Hi, sir. Good evening and congrats on a good set of numbers. Sir, my first question was on the I mean, when we are entering a new state, in fact, in the last couple of years, we've entered newer states like Bihar, UP, even Rajasthan, Gujarat. So, what is the kind of new to credit ratio that we are seeing? Because these are not our vintage states per se. So, wanted to understand what is the kind of new to credit ratio that we are seeing in these states, and also what is the thought process on ramping up our operations in AP and Tamil Nadu and Telangana? Sorry.
I think we said already, we already entered to AP and Telangana through a contiguous district which has border into Tamil Nadu or Karnataka or Maharashtra or Odisha. We opened 8 branches in Andhra Pradesh and 4 branches in Telangana in the bordering district. So that we will continue to do the same approach of contiguous district approach here also. So we have done that. The first part of your question is, that when we go to new geography, there is a less new to credit because probably we are entering to a place where already some people are operating. So, but still it will be in the range of 20-25% kind of new to credit. Whereas in the existing state, like Maharashtra, Karnataka, or Chhattisgarh or MP, our new to credit is close to 40-45%.
Okay. So the second question was what is the thought process in the sense that currently we've added 8 branches in AP and probably 4 branches in Telangana. So from here on, how many more branches do we plan to add in these states, say over the next 12 to 18 months time period? Is there a thought process to sort of scale it up further?
As a policy, we don't look at the state-wise numbers. Instead of we look at our districts actually, how many of our districts around us where we have to operate, we evaluate. But yes, Telangana and Andhra are new, but still we would go again the contiguous only. Probably we'll enter, we open few branches, we will open 2 more branches during this year or first quarter of next year, and then penetrate and move to next district. So that is what we observe. That is what the way we operate. Maybe over a period of time we will penetrate the entire state. It will take a couple of years for us. So same like we're still expanding in Bihar, expanding in UP, expanding in Rajasthan, expanding in Gujarat. Similarly, we are operating here also. So we look at district rather than state when we are expanding.
Got it. So the second question was on the non-microfinance segment that we aspire to sort of scale it up. So how is the management bandwidth that we are planning to create over the next 12 months so that we are able to scale up that segment as well?
Right. So, hi, this is Ganesh here. So from a management bandwidth perspective, I think we are adequately staffed. So we have adequate resources to take care of the newer businesses. In fact, the newer businesses, most of them are run through a separate vertical. And we have a business head, we have an NCM. So we will have all the manpower already in place. Right? So apart from expansion in field staff, we don't see a requirement coming in for management for the new business.
Got it. And the one last question was with respect to recoveries. So we have we have taken the hit of the COVID and we have written off portfolios. We have written off some accounts. So are we seeing any healthy recoveries lined up in the third quarter or in the fourth quarter, like we have seen during this quarter as well? But do you expect that there could be some healthy recoveries coming up in the second half?
The stronger recovery from COVID portfolio has almost been complete now, and for the last few quarters we've seen similar trend. So it will be in the range of around 4-5 crores a month, and that keeps coming. But as a broad guidance, we can always see around 10 to 15% of recovery coming from this bit every year.
Got it, sir. Thank you so much, sir, and good luck for the next quarter, sir.
Thank you.
Thank you. The next question is from the line of Nitesh from Investec. Please go ahead.
Thanks for the opportunity, sir. So firstly, on the new initiatives, new businesses that we are scaling up, if you can share some progress, how has the traction been in this quarter?
Okay. So new initiatives, as I said earlier also, what happened? Sorry, as I said earlier, the more of our time we spent last year on pilots, and this year we started scaling up. The two products which is particularly higher individual loans unsecured, which is not more than 2 lakhs per client, which is actually going very well. I think we should start presenting the numbers from the next quarter. And also the LAP, which is also progressing very well already. And the two-wheeler and I'm still in the nascent stage. And home loan we are planning to pilot from this year. And the last one, gold loan, we are not very sure still. So it was still in a 2-3 crores of portfolio, which we are continuing your pilot to evaluate and see whether it's the right product we should continue or not. So other products are getting scaled up. Probably from next quarter on, we'll start presenting the non-microfinance initiatives also.
Sure, sir. And secondly, from an ROE point of view, 24-25% reporting 24-25% ROE. How do you think about creating buffers for future / passing on benefit to the customer, or we are okay with 24-25% ROE, or are we expanding beyond that also with operating leverage?
No, there are two things are there. The passing on can happen through the operating efficiency, the cost of borrowing. So many of the areas are there. There are many things. I think as you said, we are seeing the cost of borrowing is getting into peak now. This actually start moving down or stable and then moving down. OPEX again, the today's 4.7 is actually basically including the investment what we are working with the retail and all these new initiatives also. So that also there will be some leverage. This all will get passed on to customer actually going forward, so that we'll be trying to keep the return intact as far as possible. And as the capital consumption is becoming more and more, and then we'll be able to maintain this easily without any difficulties.
Sure. With this sort of internal approval, we should not require capital in future because our growth is also around 25%. Book value growth will be higher than 25%. So ideally, we should not require capital.
At least for near future, we are not looking for any capital.
Sure, sir. Thank you, sir. Thank you. That's it from my side.
Thank you so much.
Thank you. The next question is from the line of Abhishek from HSBC. Please go ahead.
Yeah, hi Udaya and team. Congratulations for the quarter. So my question was again on the new products. Can you share what was the disbursement in those products in the last quarter, and let's say in a year's time, what percentage of AUM are you targeting to get to in terms of the mix?
Yeah. So currently it's about 1.5% of our portfolio approximately, and our disbursement last quarter is close to 170 crores.
Sorry?
170 crores. So last quarter disbursement is close to 170 crores. And then the portfolio is around 1.5% of the total portfolio. And then it's behaving quite well.
Yeah. So let's say by the end of next year, what percentage do you think will be contributed by this portfolio? You have any target in mind or any threshold?
I think we spelled out clearly in our analyst meeting. We said that in the 4-5 years, we should be actually achieving about 12 to 15% in this group, which means around 6,000 to 7,000 crores is our target to reach by the next 4 or 5 years' time.
Okay, got it. Got it. Thank you. Thank you so much.
Thank you.
Thank you. The next question is from the line of Arvind R. from Sundaram Alternates. Please go ahead.
Hi, sir. Thank you so much for the opportunity. I have a few questions on my mind. This might have been answered, but so the average disbursement rate is 1% higher than the portfolio yield, and cost of borrowing is also lower than 20 pips higher. Sorry, lower than the marginal cost of borrowing is 20 pips lower than the book cost of borrowing. does it mean that yields, NIMs can improve further from here, over the next several quarters? That is my first question, sir.
So NIM may not go up further because most of the portfolio is repriced already, and the marginal cost is not a reflection. You have to look at the weighted average cost, which is the real cost, which is getting into the overall financial metrics. Marginal cost is only for the cost on the borrowing for that quarter. So for example, next quarter we borrow a little higher cost, the marginal cost is suddenly go. So therefore, marginal cost is not our bearing. Weighted average cost is the one we have to look at. So we believe it will go up by another 10-20 bits maximum. And portfolio yield may not change too much because average portfolio not too much. So therefore, and then as we use more more borrowing in the next 2 quarters, because normally our disbursement or a growth, almost 60-65% will come from second half, which means we start using the borrowed money in the next 2 quarters, whereas we use more capital these 2 quarters. Therefore, with this 2-3 combination, we believe the NIM will come down. Therefore, we guided the lesser NIM than the current.
Understood, sir. So my other question would be number of branches I could see Tamil Nadu, Maharashtra, I have all similar to branches to Karnataka, or even slightly higher. But the portfolio is almost only just half of the portfolio in size in Karnataka. When can is there any target reaching the current levels of Karnataka book in Tamil Nadu, Maharashtra in next 3 years, something like that?
So some Karnataka books which is quite old branches, quite mature branches, and then we continue to grow in the same land, that is why it's higher. Whereas as we go more and more to the newer geography, that is Maharashtra was next, and then the Madhya Pradesh and Chhattisgarh, if we keep on doing, all will be less like that. It's always based on the vintage to continue to grow. So eventually most of them will reach that level. Tamil Nadu specifically, because it's many Madhura branches have become a part of the Grameen in this financial year, where those outstandings are quite lower. The average looks a bit lower. So our whole idea of Madhura acquisition is to grow there. Obviously, we will grow there. So eventually, all these will come into a similar range of productivity.
Sure, sir. Sure. Thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Kashyap Javeri from MK Investment Managers. Please go ahead.
Yeah, thank you so much, sir, and congratulations for the set of numbers. I wanted one question, which is on the disbursement side. Quarter-on-quarter disbursements have grown by about 3% and mine by about 18%, which itself looks like a slower growth. And instead for the new initiatives of about 150 crores, this number would have been down by about another 3%. So for the full year, what's our view on the disbursement growth, as well as why it would be a slower number this quarter?
So these are slower actually. If you see first half growth, in any area, probably we have done better than any other years actually. You have to look at what is the normal natural first half growth and second half growth. And we also said that we are retaining the guidance. We said that our guidance is 24-25% annual rate growth, which we are retaining that guidance. And probably I think that guidance is intact. And normally third quarter and fourth quarter the higher disbursements will happen. Therefore, I don't see any reason to worry about the potential growth guidance what we have made.
Sure. That's it from my side, sir. Thank you so much.
Thank you.
Thank you so much. The next question is from the line of Manoj Oberoi from Yes Securities. Please go ahead.
Yeah, sir. Hi, this is Raja. Congratulations on a very good set of numbers. My question is on credit cost guidance. So when I look at, you have maintained your credit cost guidance, but when I look at the collection efficiency, excluding arrears, it is at 98.7%. on the whole portfolio. Your PAR 30 number is also small. Your buckets are even smaller, and you are carrying good provisions on stage 2 and stage 3 assets. So can we then not undershoot could we have not lowered the credit cost guidance? Or are you expecting that collection efficiency may not hold up?
The credit cost is not just the PAR, no. Our credit cost itself is higher, no, compared to the, because we provided 60 days for NPA, 15 days for stage 2. So the credit cost is higher than the comparison to NPA, right? So we managed with that. Only the first quarter it was a blip and a better blip, which was much better, but that is not the comparison. But Q2 is the comparison. If you see Q2, our cost was about 4%, 0.4%, and now it's about 1.6%, right? I think we are quite in line with our guidance. And I thought suddenly you changed your name, have you?
No, just that from the collection efficiency being reported, on the whole portfolio, X of arrears being 98.7 was implying that the flows going into stage 2 and stage 3 are also less, and which is why the requirement could be low.
No, it's because of the policy. Because if you go by the current, if you go by the IGAP methodology, our requirement of provision may be half of what we are doing.
Okay.
That we are doing more, right? So automatically, cost will go up.
Sure.
As against the GNP of 0.7, we are at 1.6% of provisions, right?
Correct. And sir, on the NIM guidance again, just a clarification, because when I look at the first half NIM, it is 13.1. You have given a full year NIM guidance of 12.7, 12.8. But again, when I look at your incremental disbursement yield, it is 1% higher than the portfolio yield. So that gain will come. And unless the cost of fund goes up significantly, and I understand the leverage part that you will grow much higher in the second half. But is it just the leverage or something else also? Are you building some cushion for any other reason as well?
No, it's more of a, so look at last quarter. Last quarter, everybody has a value revival. Look at, our yield has gone up, but ROA has come down, right? So NIM is slightly gone up, but the ROA has come down, correct? It's a more linkage between the leverage, the operating cost. If the operating cost increase by 20 basis, so that has an impact, a huge ramification. Even if 10 basis increases, there is a ramification because the growth is, we are talking about opening many more branches also next 2 quarters. So we opened only 90 branches, whereas the plan is to open 180, 190 branches, correct? All these have impact. And then the usage of capital is another impact. So all these three, 4 things we have to look at together. So we did that analysis and then come out with that, the stable potential NIM for the year.
Okay. And sir, you have maintained your growth guidance, between 2 quarters. So do you see, some risks or of growing faster than 24-25%? Because we have the capacity, we have been expanding in newer markets, and the cycle is also good, collections are also good. So is there any harm in growing slightly faster?
Not necessarily, but we also believe that 24-25% is a good growth at the base what we are operating in. And then second, newer market entry will actually give you expansion, but the growth you will get only next year, not the current year normally. So I think we are preparing for the what you call the expansion for next year by entering the new market. So I think 24-25% is a decent growth. We still need to do a lot for that. If you do annual guidance so far annual growth is only 16%. We need to really grow almost about 30-40% annual growth for next second half to achieve this itself. Actually want to retain the same guidance.
Got it, sir. Thank you so much for answering all my questions. Best of luck.
And maybe one more point I want to add is we are actually strengthening our operations also in this point of time. So it's always good to strengthen our operation when the good time is going on, right?
Yes, sir. Yes, sir. Thank you.
Thank you.
Thank you so much. The next question is from the line of Shripal Doshi from Equirius Securities. Please go ahead.
Hi, sir. Thank you for again giving me an opportunity. So I wanted to check with where we differentiate among the peers in the landscape is on the OPEX upon AUM front, wherein we are probably at 4.5, 4.6%. So on that front, wanted to understand. So with that angle, I wanted to understand what is the attrition rate at loan officer level and at middle management level.
Our attrition rate is around 28%, including loan officer and middle management together. If you ask only loan officer, maybe it's about other 5-6% more, and middle management probably are higher ones above, maybe about 5% less. Average is about 28%, which seems to be reasonable for us. Maybe it's lesser than the market, but we don't have an appropriate number for other figures.
Right. And so on this front,
similarly, the customer attrition is quite low for us, which is one of the reasons where our operating cost is better, because the growth is largely coming from the retained existing customers, which is also an advantage for better operating metrics.
Right. You said 13 to 15% is the attrition for the customers, right?
Which I think we observed the industry is around maybe north of 20%.
So the customer attrition is north of 25%, you said?
Yeah, for the industry.
For the industry, okay. Got it, sir. Thank you so much. And so, just one bit on the OPEX upon AUM front, there won't be any further improvement, and you will want to maintain these levels, right?
So it's a range bound. If you see, it's always ranging between 4.5 to 5. Sometimes some quarter, it is a quarter on quarter, we don't see, and there would be some gaps. But annually, we saw it between 4.5 to 4.75, not more than that.
Got it, sir. Got it. Thank you so much, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Omkar Kamtekar from Bonanza Portfolio. Please go ahead.
Hello. Thank you for taking my question. Firstly, on the end of, I think it was previously answered, but just to get a proper understanding. So even in the guidance, we have said that NIMs have expanded because we have used internal accruals and our own funds for growth. So therefore, in the near term, I think we may not require any external funding. So I think the 990 crores that we raised, I think would be fair enough for the year.
We don't need capital. We don't need capital. Funding we need. Our book runs the 75% is by borrowing only.
Okay. So
we don't need capital. That's what you said.
Sure. Thank you for the clarification. Next, I see a small, I need a growth guidance or maybe a color from you. In the GLP product mix segment, the home improvement and the retail segment have shown good growth. So the home improvement has almost doubled, and retail finance has almost increased by 60% on a year-on-year basis. The growth has been more so ramped up since Q4, Q1, and Q2. So do we see this ramping up, and also the average amount per loan is also increasing for both? So could you please give us an understanding of how much this can go up to as a part of the entire portfolio, and will this be margin accretive?
See, Omkar, these are the products we piloted last year, scaling up this year. Last year this curve, this year this curve is 100% growth. That is what the way it was in the initial stages. So these all products are piloted last year, and we are actually growing now and scaling it up. Therefore, it's a number of, growth is definitely important, and it will happen. As I said earlier to somebody, some other question, responded to somebody. So I think Abhishek. So we have a plan to grow this, at least from the current 1 to 2% portfolio to almost 10 to 15% in the next 4 to 5 years. Therefore, there will be a ramp up of these products continuously.
Okay. Thank you. And just a small clarification on the I would want a review on the microfinance industry as a whole, or a quick overview of what do you feel the next 2 or 3 years would be for the industry, MFI industry as a whole, from your lens.
So our view is quite stable. Actually, post regulation changes, things are definitely good. Post COVID, also I think that the industry has been very resilient in terms of coming back to normalcy. Customer segment what we operate are so very resilient. So we believe the industry should actually move well with at least 20-25% CAGR growth for next 2-3 years.
Okay, so 20 to 25% CAGR on the next 2 years. Okay. Thank you very much.
Yeah, that is the potential to grow.
Thank you.
Thank you. The next question is from the line of Arvind R. from Sundaram Alternates. Please go ahead.
Sorry, sir, I just had one query. Like, so this non-GLG loans we are looking to grow. Is that margin accretive? Like, can you give me some guidance on like what would be like the yields in those products?
So these products yields are actually equal or more than the group loan actually, because since they are individual loans, we charge little higher, whereas group loan we have a differential rate between high risk, low risk and medium risk branches. Whereas here is a common pitching of about 20-23%. Therefore, yield is higher for this. So therefore, the margin accrual also higher because we are giving only for the existing customer who are moving into next level. Therefore, you don't have a acquisition cost also. So therefore, this will give additional advantage for us in terms of margin.
Okay. And like I did see like like not for CreditAccess, but for other banks, banks and NBFCs, even the sector data like loans which are like less than 50,000 ticket size started to seeing some signs of stress. Is that the cause of worry for you? Like, or do you see any issues in the ground? Not necessarily for CreditAccess, but for the industry itself.
Depends on what type of clients. If you want to go and give individual loans to a new to credit or a new to corporate, new customer, then probably there is a challenge. But our model is clearly to the existing retained loyal customers who have been with us for at least 3 years, always repaid well with the good credit history. Therefore, I think there's a very less comparison for this.
Okay. Thank you. Thank you so much.
Thank you so much. Ladies and gentlemen, we would take that as our last question. I now hand over to Ms. Shweta Daptardar for closing comments. Please go ahead.
Thank you. On behalf of Elara Capital, we thank the management of CreditAccess Grameen to give us the opportunity to host the earnings call. Thank you, and thank you all.
Thank you very much, and I think very, very happy festival season for all of you. Thank you so much.
Thank you so much. On behalf of Elara Securities Private Limited, that concludes the conference call. Thank you for joining us, and you may now disconnect your lines.